Five. So, we were talking about a bunch of stuff today. We're gonna go through a couple of questions from Kashab today towards me. But yeah, the markets in general, let's just go over some basics right now because it's just basically been kind of crazy. And if you didn't see the show this morning, I was on Stock Market TV this morning. And being on Stock Market TV was great. There's a lot of good stuff. So if you guys are on go to my Twitter, and you guys can see that on Twitter, YouTube, whatever. I don't know what they stream on like 5 different platforms. So anywhere you like to go, you can see. Natural gas continues to move. One thing we continue to talk about, that false breakdown signal continued to move higher. Great trade there. If you were in the Substack, you definitely got to see that trade in real time, and it's worked out really well. Gold. Kashab and I have continued to talk about gold and being bullish on gold going forward. Gold moving up nicely. However, silver being over $30. That's a big one today. And so if we go back, that's a new high. So silver hitting a new high it hasn't seen since 2013. So that's a long time. So it hasn't seen any of those levels since 2013 where it hit $36.37. Platinum was a new one this week. We did get a buy signal in platinum very recently. Platinum's continued to move higher, moving up about what? Let's look at the performance. Let's do month to date. And so if we look at platinum has moved up. That's palladium. Platinum moved up 14% in the month. It's actually right with silver. It's hand in hand with silver. Silver's up 16, platinum up 14, copper up 10%. Certainly looks like a commodity bull market. But hey, what do I know? Inflation is going down. I always forget that. Inflation is always going down. You stupid.
It's only 3.7%. And that's on top of last year's 4%. So doesn't matter. It's down year on year, right?
It's great.
Now going up.
It's amazing. It's funny to talk about because it's like there's so many people over the years that are like, man, you were always long commodities. And it's like, no, I actually, if you've known me for many years, like I haven't been long commodities to any type of level until 2020. Yes, I've traded them. I've been long and short them over the years, but in 2020, almost all of the signals started to turn long. And then in 2022, 2023, there was a mixture of signals. And then once we got into this year, I continued to say like all of them are now on the long side, like almost across the board, everything's been to the long side. And if it wasn't long, it was just neutral. That is very rare. So we just kind of continue to see these things. I mean, if you just look over the last week, and just in a week, orange juice up 10%, natural gas up 15%, platinum up 7%, silver up 9%. The NASDAQ is up 2%. That's pretty crazy. But once again, it's like you're seeing all of these commodities being the outperformers. And that's what the real thing you want to be in is like when you're looking at ETF traders or futures traders, the big way to have that major outperformance is to get into those things that are outperforming the broad market. So how do you do that? Well, you find the things that are already outperforming the broad market, which is hard to do because most people don't like buying highs, and nobody does. I don't think anybody enjoys it. But once again, if you start to get into those sectors that are the outperforming sectors, they usually continue to outperform. Gold, silver, copper. While a lot of them aren't something I would buy today, I do think there is more upside in all these areas.
So the only commodity pretty much that hasn't moved is sugar. Every day it's getting a beating, and I keep thinking, is this the bottom? And then no, it's not. It's just going further and further and further. And it makes absolutely no sense, but it is just puzzling at this point, like why that's happening.
Yeah, I mean, I think sugar and it's funny because there are one thing that sugar is usually pretty correlated with, and that's cocoa. Sugar and cocoa kind of make a lot of very similar runs, and sugar did, that might be the real answer to it. Sugar did make a huge run. Sugar made that run when none of the other commodities were moving at the end of 2022, and all the way until when's that? Basically the end of 23. So we had it move from, where's bottom? It was $17 all the way up to $28. So it nearly doubled within a year, which is a huge move. So basically, that same move that happened just this year in cocoa, we saw that in sugar last year, kind of moving nicely. So once again, it's an interesting one to watch because sugar is also kind of a leader. It's kind of very similar to gold. When I talk about gold, I always say gold kind of leads the way, meaning gold, when it's moving like it is right now, for example, it's usually telling you that inflation is coming. When exactly, it's hard to say. Sometimes it's within a few months, sometimes it's within 6 months. And how I actually generate these signals is I look for that breakout zone. So when it breaks out and starts to move higher is usually when you see it. So, back in, let me get a gold chart up here, because then I can talk about it in a way that everybody else can pay attention to too. So let me get a gold chart. Give me 1 second, guys. But when you look at gold, the back tests that I always look at tell me that gold usually moves before the rest of the commodities market. And it's true. It always does that. Most people don't pay attention to it, and they're like, why isn't gold working in this inflationary environment? I can't believe gold isn't working. And it's just not the way it goes. Usually it's the one that moves first. And so if we look here and we go back to 2019, the first real breakout we had in gold, I can remember that because Kashap and I were talking about and trading that at that point. You have that breakout in May 2019. Starts to move higher, and people don't remember this, but at the end, we could have went into an inflationary cycle at the end of the year in 2019. People don't remember that. There was a lot of inflation kind of starting to happen at the end of the year in 2019. So we got that breakout zone in June. Then, if you remember also, in January, February, we had this crazy move in gold. Gold started to move higher very quickly, kind of saying something was going to happen. Was that something that's going to happen? COVID? Was inflation going to get out of control? You don't really know exactly what it is, but then the market crashes. But gold is the outperformer. You can see that huge wick here that happened in March 2020. Gold came down and then went right back up. And so gold at that point, that's another breakout zone. So gold goes sideways at the end of 2019, and then it breaks out, moves back up in 2020. And then basically after that, we get into November 2020, and this is when all the commodities start to move. They start to move almost in sync, and gold tops out there. Now we're here in this next round. And then if we go to that breakout point, the real breakout that actually happened that most people don't talk about because it kind of wicked back down was actually in 2023. We had the breakout that happened in 2023. It hit a new high, and then it chopped around, and then it moved higher. Now we're seeing some of the other commodities starting to catch up. The one that's usually the last one to the party to really start to move is usually oil. Now remember, if you go back on oil, go back to 2020. If you go back to 2020, you'll see that the energy markets didn't do anything really all year long. Yeah, there was a rally out of the lows and so on, but really it just chopped around. And then November was when energy started to move. The rest of the commodities started to move before that. If you look at soybeans or the ags or sugar even, most of them started to move before that, but oil started to really make its move after that. Copper is also another one. Copper started to make its move way before oil as well. So I would think that the playbook here that people aren't talking about is that oil is going to start catching up. Copper's already here. It's already starting to move. Oil at some point will catch up. Do I know exactly when? No, you can't exactly pinpoint that, but you continue to wait for signals. And when you see those breakouts or those buy signals in oil, you want to buy them because the market's telling us something, and it's telling us commodities are moving higher.
Yeah, I think that absolutely makes sense, and I think that's something that I think people miss as well. Like everyone looks at, if you're trading on an intraday time frame, you look at your 5 minute chart or your 10 minute charts. On a daily time frame, you look at your daily charts, and your maybe you look at a weekly chart, but almost no one really goes back and does a long term chart
Mm-hmm.
because it doesn't really make sense to their time horizon. But I think there's a lot of value in just trying to understand where the market has been. And that's the whole point of charting, to understand where the market has been. So I think that's something that's really important. Like when you, for instance, you bring up 2020, that oil started to move after gold top out. So when you see that and you see something similar happening today where oil is kind of struggling, it's not exactly uh, like, I mean, in 2020, it went to $0. So it's not
Mm-hmm.
exactly struggling like that, but it's kind of hard for oil to break above 80 now, whereas you see gold running. So maybe, just maybe, once gold has its good run, maybe that's when you'll see oil start to catch up. So if you can look at these long-term charts, maybe as a discretionary trader, you can kind of figure out where exactly you should be positioned. And that's kind of more important than just putting on the individual trades, because the big money is made in those allocation decisions, not just in the individual trades. Of course, the individual trades, that's what contribute to your P&L. But for instance, if you can see the breakout in China, you can kind of understand the long-term history. China hasn't had a bull market since 2014. That's 10 long years. And then when you get a breakout signal, that's when you know you can actually allocate to that pretty heavily, because it's been a market that's been sleeping for so long that there's a good chance this is not a false signal. So I think those nuances you can only get when you look at the long-term charts, or of course if you read history. So either way. So guys, so today I want to do something a little different. So I know Jason always does these talks and he asks the questions. So today I thought, given how much I know Jason, like we've been friends for a long time, let me just flip the camera around and ask him the questions. And because I think there are some very fascinating aspects of his life story. I'm sure he's mentioned them in his TED Talks, he's talked about them, but I just thought, let me get some of those uh, insights from him out here in this conversation. So, Jason, I think we've known each other since 2017 or 18 or sometime
Yep.
thereabouts, and like I know that time you were riding BMX, you were talking about that, you were putting up all those videos on Facebook, which were pretty cool to see. So let's start there. So as a kid, you started with BMX, and
Yes.
how did that come about? Is that a very usual hobby or pastime, or is it something that usually gets kids at that age? Because I mean, I'm from India and
Mhm.
we don't really do that. Like I never seen that in India actually. So it's something that fascinates me.
So when so if you go back to the 90s, in the 90s in the United States, there was a lot of it. BMX was kind of everywhere. There's the X Games. When I started, though, it was pretty dead. There wasn't much of a sport. There wasn't really a lot of people riding. I was interested in it. I saw the X Games one year, and somebody was riding that I really liked, and I was like, "Wow, that's really cool." I wish I could afford a bike. And I remember looking at it online and it was like thousands of dollars. And I was like, okay, well, I guess I'm not going to do that. And then I had an uncle who worked at a drug mart at the time, which is just like a corner store in the States. And he said, hey, I got this guy who works for me. Or with me. I guess he was the manager there. And he's actually a councilman in our city at the time. And he was selling a bike, a BMX bike. And I was like, okay. And he sold it to me for $80, which is ridiculous. Like it was really cheap. Granted, it was pretty old at that time. It was outdated, But I still have that frame to this day. I actually keep it with me everywhere I've ever been. It's always been like part of my house. Like it's on the wall. Like it's always around. So he gave me this bike. It was only $80 at the time. Something to talk about though about what you said. So traveling over the years, and getting to these other areas like China, Japan, Europe. I've been all over the world doing this, even the Middle East. People don't ride in the same way. Like Europe has a pretty big scene, but there's not a scene anywhere else. So like I would literally go to these other countries and we would like go outside and just like ride around in a random parking lot. And there would be people throwing money at us. Like it was the craziest thing they've ever seen. And they're just throwing $100 bills and like whatever. Like they would know we're American and be like, can we switch money? I remember getting a bunch. I still have it to this day, a bunch of yen. So I have a bunch of coins, and I still have kept it to this day. I think I actually gave it to my daughter at one point, a couple of them. But it's really like just kind of interesting to see the difference over time. And like you go to Europe and people are like doing the kind of the same thing in certain areas. Like once you get to kind of Eastern Europe. So that's a kind of an interesting thing, because you're right, it's not a big thing out there. But when I was growing up, the X Games started becoming bigger, and by the time I was competing as a professional, like it was at its biggest point. And I'm fortunate to have lived through that, because it's definitely gone the other way as the years have moved on. Meaning at its biggest point was we were doing, there was huge sponsorships. People would be like, hey, can you put this sticker on your helmet and we'll give you $20,000? And I'd be like, sure. Like just things like that were coming up. And it was pretty awesome. Granted, it's not ever like the money was like insane or that we were making like millions of dollars or anything, but it was sustainable. And I got to live many years just riding my bike and traveling, which also gave me a lot of time to read and work on other things like trading. I got to basically, you're as an athlete, you're still working out and practicing every day, but you're not working like that mundane 8-9 hour job, come home tired, go to sleep type of life. So I had time to read, time to work on myself, time to learn different things. And it was a really cool opportunity, and I really never would have thought of it that way until I got older. At the time, I just thought it was just what I like to do, and I hope I can make enough money to live on it. And I would have honestly, to be good, like it's funny, I had this conversation with somebody recently, and it was to be good. I would, if somebody was like, hey, like you're gonna make $0 doing this, but you're going to be the best in the world. And you can learn anything, any of the tricks you ever wanted to do, but you're probably going to be sleeping on sewer grates. I would have said, sweet, great. I'm going to be the best in the world. Like I wouldn't have thought of anything else. So it was very, I was very passionate about it. I loved doing it. And it really kind of set the table for the rest of my life and everything I was ever doing. And I continued to run these companies, and I learned a lot about, managing people, because I started to run funds. And so when I'm doing that, I can't really be on the road all the time anymore. And so when I couldn't be on the road all the time, I had to find managers and learn how to run transportation businesses and so on. So, basically that just helped me in all the other aspects of my life, and not to mention all the infrastructure things you learn setting things up like that. Like we had to do some of the Middle Eastern shows that we did. We had to set up 5 or 6 people, and we set up 5 or 6 people, and they go all the way out to the Middle East. And like these 5 or 6 people have to be able to build ramps. They have to be able to ride, do the tricks. They have to be able to handle that be old enough to go on a trip like that. Be smart and not stupid enough of doing some stupid shit on the road, which happens quite a bit. And so you have to learn all of those things, and then you have to figure out like what type of people you want around, or what type of people are dependable, and you have to learn how to read that stuff on the fly. So like what type of people would you want to be around in a situation where you're stuck on the road with them for 2 years? That can be very important. You don't want to send 2 people together that hate each other, and it could turn into a bad situation. So, it helps you learn like, hey, how do you set up a business? How do you set up logistics? how do you, and especially back in the day, like the most interesting thing and the thing people don't remember because is that we didn't have things like GPS, you know, like we didn't have GPS back then. So going on a road trip was like, and not to mention, you can't just map quest everything. Back in the day, you could print stuff out and be like, okay, I'm going to map quest. It was called MapQuest, and you could map from, you know, where I live all the way to the show. But if you're on the road for months on end, like you have to figure out how to read a map. So you learn how to read a map. You learn how to be very thrifty. You learn how to fix cars because you might be stuck in somewhere for weeks, if not. So you just have to continually learn more and more stuff in that. And like it's cool because to this day, it's like I'm very mechanical. I'm an entrepreneur. I'm very self-sufficient. So all those things that came from my life back then that I would never, and I think that's the thing a lot of people think. They think that, hey, I'm a professional athlete. I have no other skills. I'm an idiot everywhere else. And that's not true at all. The thing is that as a professional athlete or whatever you do as a child, like you, whatever things you've done in your life is usually applicable in some sense to your future. And for me, all of that stuff was very applicable to who I am today and where I am now.
That's really fascinating, and I just want to get back to that point that you made on how riding BMX taught you so many other skills. So, do you, as a professional athlete, let's say you had picked some other field, do
Mhm.
you think your experience would have been the same, or would you have been ultra focused on, let's say, if you were into basketball or
Mhm.
swimming or track or something else? I think probably then your skill set wouldn't have evolved the way it did because those are more defined sports. Or is that just my perspective? Because that's how it works in India, where
Yeah, I
if you're
think
a
it's
kid,
all
yeah,
I think it's all applicable. So if you're a basketball player, you have to. People would go, okay, well, you just throw a basketball in a hoop, and it's like, well, no, not really, you know. And well, you have to understand team building. You have to understand. Once again, you have to learn how to motivate people. Like I was a point guard in basketball when I played. So you have certain people around you. You have the guy who's huge and 7 feet tall, and he's scared to do anything. And you're like, well, I don't understand this dude. He's if I was 7 feet tall, I would be doing everything out here, you know. And like your brain thinks that, but really you have to figure out how to motivate that type of a person. And you go, hey man, you're doing like you figure out, oh, he's a person where if you tell him he's doing great, he's going to do even better. Or if you tell him, hey man, like you're kind of sucking today, maybe that's what motivates him. Or hey, you know, like make him laugh, you know, like you start to figure out how to drive people to make them better. And that's the same thing, like, you know, you got a person who's a great shooter but they never want to shoot, and so you tell them to shoot, hey, shoot the basketball, you're gonna, I don't care if you brick 20 shots and you miss 20 shots, it doesn't even matter. And you find out that that might motivate him. And so you learn those things, and those things are very applicable going forward. Like if you have a business, you have to figure out how to motivate people, and most importantly, it's the treating people well. You know, I think a lot of businesses don't understand that, like, if somebody's happy in their job, they're going to do much better. You know, not like you got to figure out what drives people. Do they want to be at, if I hire somebody and figure out, do they want to be with me forever? Is that their goal in life? Like, do they not really have goals of their own? Okay, they want to be with me forever. I understand that. So I know how to drive them. Then let's say there's other people, and I take people like this on too, because I'm not a person who's like, oh man, like you want to start your own business, you're a piece of shit. Like I think you want to start your own business, fantastic, that's awesome. Like please start your own business. You know, I'll help you, because guess what? That's how every business owner gets to where they're at. So you know, hey, I'll help you start your own business. You know, you want to work for me? I'll be the one to teach you how to do this, and you can see the everything behind the back door, and I'll help you do that. So you start to learn how to motivate people. So I think it's all applicable. You just have to kind of think about how it is. It's kind of the same thing. Like if I'm speaking at a rehab center and I'll speak to an addict, and they'll be like, man, you know, like I don't have any skills out there. And I'll be like, well, you're the best salesman in the world, you know? And they'll be like, what? That doesn't even make sense. And it's true. Like, You might, as an addict, you might have to get into situations where you have to raise money for yourself, you have to lie to people, you have to do all of these things. So maybe you figure out a way to do that all legally, maybe you do it in a nice way, maybe but as an addict, usually you're a very convincing person, so you can figure out a way to do it in a way that you're selling a product that you like, that you believe in. Something, I'm not saying like a used car salesman and selling a car without a that, then you're just an asshole. But I'm just talking about if you're just a normal person, you're creating a good business, like being able to sell that business, being a good salesperson in that, that's everything. Like that's really, if you look at the people who have really made any amount of real money over time, they're all people who are great at sales, all of them. And because it's the same reason why you and I see people, and maybe I'm not as good at sales as I wish I was, but you and I know plenty of people in these industries that sell everything they do, and we're like, how is this possible? Like like you have the worst product on earth and everybody's losing money, but somehow you're still selling it all the time. So once again, it's like there's just two different worlds there, and not hating on it. Like, once again, like, you don't have, if you write interestingly and people want to read it, I don't care. That's not my point. And my point is that there's many ways to make money, and you just got to figure out your strengths and how you do it.
And I think that also you have to fit your style to your personality. That's the other aspect of it. So that's something I wanted to get into. So
Mhm.
I know you talked a lot about BMX. I've seen some of your videos, and
Mhm.
I've seen some of those videos where you say that you're going to wipe out at the end of that stunt and you still
Mhm.
do it anyway.
Mhm.
And then you had a Facebook post recently about how without pain and suffering there is no progress, and
Mhm.
how you as a kid you learn to deal with that. So you picked a profession, you picked a sport which had quite a bit of pain, and now you have picked a profession which is trading, which also has quite a bit of pain involved. So is that something that goes with your personality?
Yes, completely. And so it's did I pick BMX knowing that all the pain would be involved in it? At the time, no. Not exactly. And it's interesting, as I get older, I think about that I was actually not a very tough kid. I didn't like being in pain. I didn't like hurting myself. Like, nobody likes it ever, but I really tried to stay away from getting hurt. Um, and then riding, like, I found something that I enjoyed to do so much that I was okay with it. I understood that it was just part of it. It's part of that. Being in pain as a professional athlete is going to happen. Like, if you want to be the best, you have to be willing to sacrifice things. And one of those sacrifices might be your left leg, and you have to understand that that's a possibility. Now, am I excited today that some days I get up and my knee is bothering me, or my back hurts or something? Like, no, I'm not excited about it, but I also know, like, I got to do the things I wanted to do with it. And I focused on that so much that I was able to be as good as I got because of it. And I think that's really important, because most people don't get to, most people get into things and they're like afraid of it and they're in fear of getting hurt, and then they just don't do it to any extreme level. And it's like, if you want to be the best, you're gonna be in pain at times. And it's the same with trading. If you want to be good at trading, like, you have to understand pain is gonna come in there. You're going to get hurt as a trader at certain points. You're going to have drawdowns. You're going to feel like crap about those drawdowns. Like, you're gonna be depressed about it at times. Like, there's so many things that go into trading that's painful, that you just have to be okay with. Like, you just have to understand, like if you're, especially if you're running funds for people, this is like the key to all this. If you're running funds for other humans, and you're going, okay, well, I'm going through a drawdown. You already feel like crap about your drawdown, but at the same time, that's part of the strategy, so it's going to happen, so you can deal with it. But then what if you have 3 people calling you going, hey, what's this drawdown thing here? You know, because they think in their head that they gave money to a professional investor, therefore there are no drawdowns anymore. I mean, it's a ridiculous statement, because without drawdowns, there's no returns. But at the same time, they don't understand that. So, you know, over time, like there's a lot of pain that can come into play. But at the same time, I think it's important to set up expectations for everybody. Set them up for yourself. That's why, like, I made that post, like, hey, there's pain that's going to come as a trader. Set up those expectations. Understand you're going to be in pain, especially as a money manager. You're going to be even more pain. And it's the same way I set up those expectations for bike riding. You know, there's just pain in all of it.
We're talking about life experiences here.
Yeah, life and how it pertains to trading. So when we're looking at like trading in general, you know, how Kashab asked a couple good questions. One was riding to trading, and he also asked about basketball to trading. And like I was talking about the fact that as a point guard, because that's what I played, as a point guard, I'd have to figure out how to make everybody do their job. Hey, you're the 7-foot dude who's afraid. We had this dude who was 7. He was huge, and he was just terrified of other people. He didn't like contact, like, and you're just like, wait a minute, dude. You're bigger than every single person on the court, and you're afraid of other people. So you'd have to figure out how to motivate him, and motivating him was, you know, telling him how great of a job he was doing. Oh man, you're doing great out there. Or hey, you look a little timid out there today. What's going on? You know, like these things motivated him. And then you have a shooter that's like afraid to shoot. He's a great shooter, but he's afraid to shoot. And you're like, dude, I don't care if you miss 20 shots. Like, you know, it doesn't matter. I just want you shooting. You're the best shooter on the team. Like you have to learn how to motivate people. And that also works in business too.
Everybody knows the soft big man and the psyched out shooter. Yep. Shout out to you, dude. I'm so excited for our Off the Charts podcast.
Yes.
We talked all about this stuff, and I thought it was just incredible. I think it's the best one that we taped yet. So kudos to you. I think everybody's going to love that. I think it's out today. I think it's out. I'll double check. Next Friday. But you speak so openly about your experiences and your past. And I think that's so important because you're not only aware of how it's shaped you and helped you in many cases as a trader, but you're willing to talk about it, which a lot of people wouldn't, right? So we get on the show Off the Charts and we ask everybody like the weirdest questions. And you just came out being brutally honest about your past and how it helped shape you. If you weren't such a good addict, you probably wouldn't be nearly as good of a trader.
That's a damn truth. You know,
right?
Yes, it works hand in hand, right? Because it's like my greatest ability, and I think my fiance has always said this best, which is, what's your favorite? We were going to be on some TV show, and they asked the question, what's your favorite part about Jason? And she said, well, that he's a monster truck and he can monster truck and get through just about anything. Yep. And then they said, well, what's the worst part about Jason? She said, well, he's a monster truck and he can monster truck through just about anything. And like, that's the best way I've ever put it, because it's like, it can be your detriment. It could be the reason why you don't ever get out of a bad thing, because you're just used to running through walls every day. Or it could be your strength, where you run through walls towards good things. So it's just like, you figure it out one way or another. And I think that's incredibly important as a trader, is like, you have to have the ability to run through walls, right? But you have to have also the ability to recognize when you're wrong.
I don't know anybody who can take a steeper drawdown than myself, except for you. I think there's a reason why we fall into that category, right? You talk about how there's the pain is really okay because you are so comfortable with being uncomfortable, right? So like, you welcome these drawdowns, and I think that's kind of trained us in a way to really take advantage of bull markets. And it's not because it's not anything that we learned from the market, right? A lot of people just can't stomach that. They might even say that they can, and then when the time comes, they'll pull the trigger and get out at the worst time, right?
I think it's also part of my strategy. So drawdowns per position do not bother me at all.
Right.
Drawdowns on the entire portfolio would bother me. So per position, like Coco pulling back 20% before it gets stopped out, that doesn't bother me at all.
Yeah.
But something like if my portfolio pulled back 20% because of Coco, that would bother me. So I think it's understanding yourself. One, like you said, understanding yourself and your tolerances as a trader. If you don't understand that you have if you have a low risk tolerance, that's okay, because it's the argument that Jerry Parker and Tom Basso always get into.
Yeah.
You gotta let the trend run, and trend following plus nothing, and pullbacks don't matter because the data says you'll make more money like that. And that's how I trade, and I also agree with Jerry on that. However, like Tom says, which is he goes eyeball target. I shave down. If Coco's run up 200%, I'm gonna cut the position in half twice probably. So that's something that Tom Basso will do. And so for me, I say that you just have to figure out what type of trader you are. Like they're both successful strategies. It's just, can you handle having Coco gain 200% and then giving back 20% of a 200% gain? Because that's not giving back 20% of let's say the position's $10,000. That's not giving back 20% of $10,000. That's a position that has gone from $10,000 to almost $40,000. So can you give back 20% of that? So you have to understand those things about yourself. And once you figure out those things, if you can handle it, then you can make a lot of money. But at the same time, there's a lot of ways to make a lot of money.
So I got something for you guys that I was thinking about this morning on my walk. You're a systems guy, big systems guy. But do you change your systems at all or alter your behavior based on the environment? Let me explain. We use different tools in different environments.
Mm-hmm.
There's certain data sets that I'm not concerned with in the middle of a bull market, but I'm very interested in at turning points, right? There are indicators that I don't want to use if I'm looking at a range bound or trendless chart, but I would definitely want to use when I'm looking at a trending chart. I enter and exit trades differently also based on the environment. I'll buy weakness in a bull market. I'll try to jump an entry on a base breakout or a textbook reversal pattern before it's really completed, right? I would never do that kind of stuff in a bear market. Do you find yourself behaving any differently, you guys, in bull markets versus bear markets? Because I was like kind of yelling at myself internally, and I was like, no, I thought about it. I was like, no, that's right. That's okay. Like, I feel like I'm cheating a little bit, but I'm just changing my behavior based on the environment.
No, that's a great question. Kashop, do you want to go first?
Yeah, sure. So I think a bull market is very forgiving of mistakes. So you tend to make a lot more mistakes. Mainly because whatever you think is a mistake turns out to not be a mistake 2-3 weeks or months down the line. So you can take that increased risk. And that's, I think, where a lot of people start to get reckless as well. So that's where people add leverage, people do all sorts of crazy things. Like with Bitcoin, there are people posting about how they are taking credit card debt to buy Bitcoin and how they are up so much and how, they are geniuses for doing that. And you get all these reckless, crazy behaviors because all of it makes money. Now, I know there's a limit to the level of mistakes you can make, but I'm absolutely a lot more careless during bull markets, and I would never do that in a bad market. Like, never.
You get bailed out sometimes by the bull market,
Yeah.
I don't know. What about you, Jason? Jason's going to be like, no, I do the same thing no matter what day of the week, what market, whether it's raining or snowing outside. No,
you're right.
Yeah.
I mean, so let's let's understand environments, because that's also very very important. Environments are very important, and to me they're very important. But I go through the same process to figure out the environment constantly. It's I have systematic fundamental models. Actually, I don't talk about these much, but I do have them. And then I have systematic macro models, which are mainly technical based, intermarket analysis based. And so by looking at those, that's how I can kind of tell what environment we're in. And not to mention, like, you have to understand, like you said, like in a bull market environment, and just like Kashab said, which I thought was a great point, which is like mistakes aren't mistakes in a bull market. That's really insightful, because I think a lot of people, you know, what's the phrase? I remember there's a great trading phrase that people use, which is like, you don't confuse brains with a bull market. Don't confuse brains with the bull market.
I have it here.
Don't confuse brains with the bull market, because if you're thinking you're a genius as you're running through this bull cycle and you're making all this money, you're going to give it all back, because you're going to think you're a genius in the bear cycle. So you have to have ways of identifying the bear cycle, identifying tops and turning points. So I just like you do, you know, like, you start to pay attention to, oh, breadth is looking rough here. And I don't look at breadth as just the NYAD line, because people are like, oh my God, the NYAD line didn't do anything for so long. It's not just that. There's a lot of things to look at. There's stocks over 200 days. There's stocks over 50 day, which I think is my best indicator that I have used for years, which is, I call it the bull bear indicator. And it's a certain threshold, and when stocks get above this threshold over the 200 day, or stocks get above the threshold on the 50 day, that usually tells me what type of market we're in. And so also you have to understand when you're in a range bound market. If you're a trend trader in a range market, you're going to get killed, and maybe not killed, but you're going to get chopped up. So you have to figure out, how do you identify that? How do you identify levels of low liquidity? I do these things. Most of the systematic traders don't. Most systematic traders think that that's, you know, not even a thing to do. You don't really need to do that. And I also, like, I can see their point, but at the same time, I have to just go with what works for me. And what works for me is identifying the different market environments and kind of putting my foot to the gas at certain points. For example, if I'm having a good year, for example, the fund's up 20, 30%. I will start to make the position sizes a little bit larger. I will start to push a little bit harder at certain points and really try for those, you know, big return years where it's like the 80, 100% return years. But you can't really do that without really identifying that we're in a cycle. I'm really, number one, my system's very in tune with the market. Sometimes people say I'm very in tune with the market. I think it's your strategy is very in tune with the market.
Yeah.
So as a trend trader, everything's trending, everything's moving. Okay, so I've identified that. Now I can start to go a little bit bigger. I have a good return. I have a good base. I'm not going to go back to zero. So I might end up with a 10% return instead of 30. That sucks. That's a lot. That's a big drawdown, but that's the max I'd probably give back in that situation. But most of the years when I identify those things, and Kashab's seen this for years because I've shared my returns with him for many years. When you're in those type of environments, most of the time, that's the years that I have the 100 or 179% return years. So you really have to, I think it's a great point that you brought up, which is no matter what it is, whether you do it like me and you do the same thing every day, or you do it like Steve or anybody else and you do it in a different way, just identifying the market environment. That's important.
Couldn't agree
So
more.
during these periods, do you increase your leverage? Do you optimize your system? How do you drive for those extraordinary returns?
So instead of going from 1% per trade, like that, basically my max loss per trade is 1%. I'll start to step that up to 2%. So now we'll go to 2%. And most of the time, sometimes the positions end up working themselves out. So most of the time, the positions, the max loss per trade will grow based on the volatility of the position. So Coco, for example, the max loss per trade obviously became a lot larger. And the max loss I'm talking about is for my whole portfolio. So for the whole portfolio, Coco went from a 1% to a 4.5% at the end of the trade of my whole portfolio. So that's actually very large. For a retail trader, they'd be like, that's not really that large. No, that's actually really large. That's a huge move. Yeah, that's went up. But what I do and how this really helps me is, one, I don't add to positions and I don't add more leverage. I already trade futures. I have enough leverage. I don't need more leverage. And because I'm not adding to positions, I'm not adding leverage, I'm able to kind of sit on my hands, and this naturally adds leverage to the winners. And if they're going to keep winning and we're in the right environment for that to keep winning, they're going to just compound together and make bigger returns. And so this is like those years that happened in like 2020 and 2021. Everything continued to compound together. I'm actually building like a whole new portfolio right now. So I'm going through those years in the futures and the ETF portfolios, and I'm seeing exactly how that all happened right now, which is cool to go back and kind of pay attention. But it's because of you had oil just raging all year long and compounding together. And those drawdowns and those pullbacks, I wasn't shaving off the positions. I wasn't doing anything to them. And so as that compounded together, it started to make more and more money. Same with all the commodities across the board. And not to mention a lot of equities, the energy sector, and so on. So as you continue to just kind of hold those positions and they compound together and get bigger and bigger, this is where you get those superior returns. You know, Trader Vic talks about it in his books and in Market Wizard. You know, look, the pursuit of superior returns. And I use the same, and I learned the thing I'm talking about is I learned straight from him. Talks about in his book. You grind your way up to a good return, 20-30%, and then you start swinging for the fences. You can either figure that out in a way like I do, like maybe your new positions, the stop loss of your total portfolio will be 2% instead of 1%. You can do that by pyramiding into positions. That I don't do it that way, but some people do. Or you could do it by trying a very crazy trade. Now, I don't like to do that because I don't think there's any one trade that makes my portfolio. It's like we talked about earlier with the drawdowns. It's not drawdown per position. It's fine with me, but drawdown for the whole portfolio, I have very smooth returns. And that's surprising, but it's because of that fact that I go, okay, well, I'm going to make sure my portfolio is uncorrelated. I have many returns. So even if I'm putting on, for example, the November election, 2020, that trade was like lumber. There was lumber, energy across the board, heating oil, gasoline, oil,
Copper,
copper. Yep. You go down the list and you have all these different things. So most of the time, any theme I'm trying to take advantage of is going to be many trades instead of just one trade. So I think it's important to dissect it in a way that makes more sense like that, because you can't, like, for example, 2020, if you'd have bought most of the commodities in 2020 in April, you'd have made money, but oil would have been the one that cost you a lot of money and basically killed your whole portfolio. So you can't just buy oil and say, hey, this is going to be a great trade for commodities. You'd want to buy a few. And so maybe you get stopped out on one and maybe 4 of them go up. Make sure you're taking signals on a lot of different things, especially if you're going to trade something as diverse as commodities.
You ever just add like a really junky gold miner or something, like some sort of like penny stock junior miner? Just like
the only time I ever do anything like that is my personal portfolio, and it's because Kashop will talk about it. that is about it. Kashop, over the years, we had a couple really great trades like that. Kashop mentioned shipping companies.
Right.
I would put those on my list. I would figure out which ones, because there's no ETF for them. So I would figure out those on my list, figure out which ones I'm exactly going to trade. If you go back actually to our old post, you can actually see a lot of these.
Dude, they brought it back though. They have a Sonic Shares has a global shipping ETF now. BOAT.
Do that. Kashop, is it garbage?
This thing's mooned.
It's
mooning.
Yeah, it has a lot of Hong Kong stocks though. It's not fully
it's
US
what?
stocks.
But so these
It has yeah.
No, go ahead. Sorry.
Yeah, no, I was just saying it has all the Hong Kong stocks, and I don't understand that market particularly well.
Mm-hmm.
So it's easier to just deal with the US listings.
These are stocks just in general. Like we just discussed, like junior gold miner.
Mm-hmm.
Basically a holding company that owns a parcel of land, right? These tankers too, I would put in the same category as like a junior or very speculative gold miner. These are not stocks that I buy in every environment, but in bull markets, like these are exactly the kind of stocks that I want. I want the most offensive, like most risk on, names that will give me the highest beta, right? The most juice for the squeeze. Oil tankers, junior gold miners, junior silver miners, like, let's go. But these are not companies I would even, look twice at in a bear market. Never, right? Bitcoin miners, Carvana. These are stocks that you can own in bull markets and probably want to stay the hell away from in most environments.
In most environments, yeah. I mean, it's tough, right? And I think it's also goes with understanding yourself. Like I don't feel like I have an edge in that area. I don't have an edge in that area. And also I have a lot of leverage. So, when somebody looks at copper and they go, cool, copper's up, 10% this week. That's great. And they're thinking of like something that's up 50, like the amount of leverage I have, copper's more like 80%, like it can be something huge because you have that leverage. Now you don't have to go, 1-to-1 or 1-to-5 leverage or something crazy, but just by having a little bit of leverage, now you're taking a 10% to a 15-20% return. And I think that's why I kind of don't really need to move into that area. And I just don't have an edge in it. I see Kashop's working it over the years and like what he does with it. And once in a while, I'll get some names from him that I'll be like, okay, I don't really have a shipping ETF. I'm going to look at these names, build it in a way that's kind of like an ETF for myself. But that's about the only time I do any of that. I like the ETFs in general. I just kind of trade them. I try to stick to the large cap ones.
So for me, when I look at an ETF, I look at the names in the ETF and I think I can do better than that. Like I can pick stocks better than they do. So that's why I go with
I mean, we typically tell clients, you don't want to own a fund. You want to own the stocks that are driving the performance of that fund, right? So if you want to own something like Boat, go pull up the Boat holdings, chart them all relative to Boat or, some marine shipping index, their peer group, right? And then you pick the best ones.
But the problem is for me that sometimes the picking the best ones can sometimes turn out in a very different way. So it's you have the idea that you can just go in and go, hey, I'm going to grab this, that, or a couple other things, and you can do that. However, owning that basket kind of insulates you. And as a trader, I think if we just think about the downside all the time, and that's all I do. I don't think about the upside. I just think about the downside. Futures, why do I trade futures? Well, why do I like it so much? Overnight, if I get stopped, I get stopped. I don't have to wait for a gap in the morning or anything. I can set a stop very easily. Trailing stops are very easy. Any way you do it, futures kind of has that interesting risk management built into it. Whereas like an option, like I do have to deal with the gap risk. I do have to deal with a lot of other things. So even in futures options, you do, because over the overnight market sometimes is just so thin. So I think it's there's a bunch of ways to look at it. It's very hard to know the winners, for me at least. And the one thing that I've learned just from back testing individual stocks is that it's the hardest thing. And I say this too much, and it probably sounds ridiculous because I say it all the time, but you never know where your biggest winners will come from.
Yep. And
because you don't know where your biggest winners will come from, I think it's easier to buy a basket. I would love to have the idea, and like you said, like finding more than one. Like even whatever way you do it, you can buy the ETF, you can buy 5 or 6. Like there's a bunch of ways to do it. I think it's important to do it in that way, where you're not just owning one thing and you're putting everything on black. Basically, you're gambling if you're just buying one thing and hoping that it's going to lead the way forever.
And I think based on the industry group or like the theme, also certain themes lend themselves more to just owning a fund or owning a basket. So like, let me give some examples. Biotechs this is an incredibly binary group of stocks, right? When certain environmental factors are in place, right? A group like banks or insurance companies, they're more or less all going to go up together, unless unless there's like some sort of individual stock that's like doing something seriously wrong or has some real problems. Like they're more or less going to move together. Something like biotech or uranium or junior gold miners, right? These groups are so bifurcated between the winners and the losers that you have two options, I think. You either create your own basket, which isn't for everybody, right? Like your standard retail investor, I think the better advice would be just go buy the fund, right? Don't even try to pick 4 or 5 yourself. You could do that. Like we could easily do that using technical analysis and relative strength, pick like the 5 best components. But I think for certain stuff, like for most people, just go own the basket, right? You get the good ones and the bad ones. And if it's more good than bad, right, it's going to balance it out and you're going to be trending higher and it's going to work for you. And you don't have this single stock risk of they just announced phase 2 trial data or they just admitted that there's no gold in the ground, right? And the stock is down 40% and you pick that one. Oh, damn it. Yet gold is in a bull market or biotechs are in a bull market, but you just picked the wrong one. That could be one of the most frustrating things as an investor, to pick the right theme, right? But the wrong vehicle.
So I think that's
kind of protects you from that risk, right?
Yeah, so that's one. The good thing about the ETF in general is that you have liquidity at all times. But the flip side of that is you're paying a liquidity premium. So the bigger ETFs like SPY, I mean, it doesn't really matter. You can trade the individual names. You're able to get in and out. But let's say when you're going to the gold miners, let's say you're going to the biotech stocks. So the XBI holdings, almost everything is under 10 billion market cap. And the trading volume is probably $1, $2, $3 million worth a day. Same with you pick XOP, you're going down the list, the holdings that are giving you the highest beta, they don't trade all that much. So if you're buying those individual names and you have to get out, you might find yourself blowing past your stop losses. You might find that that thing doesn't trade at all. So I do the reverse of this. I take on the liquidity risk. I buy these small cap miners, small cap gold exploration stocks, small cap shipping stocks, which badly trade. And when there's a good news and it trades, that's when you get out because at that time liquidity comes in and you're kind of capturing that liquidity premium by doing that.
These low flow issues, you always want to be out on strength, right, Kashab?
Right. Yeah.
It's very hard. It's just one of those things that I've seen over the years. Like once again, it always comes back to the same thing we've continued to talk about, which is you have to figure out what type of trader you are. And I know, like I watched Kashab do it for years, but I am not Kashab, and also Kashab has seen me do what I do for years, and he is not me. So I think that's important. I think too many traders kind of surround there. It's almost like an echo chamber. They surround themselves with the same exact trader that they are. And then they don't really respect the other ones. They're like, oh, you're crappy because you do it this way and you do it this way. And like, I always make the joke, like, and it's not even a joke. Like I really did have a guy that I worked with for years. And, you know, Kashab knows about this because I've used the analysis like before. I don't do it anymore because it's so taboo, but like he made money using moon patterns. Like the dude did it. And I have no idea how it worked or you know, how exactly he just used nothing but it. And I don't know how. I know people who trade nothing but fundamentals. I know people who use old school PE ratios and that's it. And they made money. I don't know. I just know the way I trade and the way I make money.
And guess what? It's one of those things where it's like, wow, like they figured out something, right? And you'll probably never figure it out and it doesn't matter. You don't need to. But they still have something in common with other successful traders, moon pattern people I'm talking about. They're managing risk, right? So we're all doing that in the same way or a similar way.
So that's what he would do. He would manage risk. Yep, he would manage risk. And really, like, I think at the end of the day, so there's the most interesting thing that you'll ever learn about trading is the coin flip system. You know, Tom Basso did this years ago. You basically flip a coin, heads or tails, buy or sell this. Okay, I'm going to short this. Okay, I'm going to buy this. But you use your best risk management parameters on this strategy, you make money still.
Yeah.
So what does that tell you? That tells you that what you do and what you think and being right doesn't matter at all. It's just about managing that risk. That is everything.
It's about surviving, so that those moon patterns can eventually hit. And sometimes
Yeah.
the moon patterns will be great and they're hitting, right? But you survive to get there. Or maybe you
Yeah.
have some very different strategy, but it's that survival, it's that risk management that really gets you there. And we all have that in common as successful traders. You don't ever want to like think too hard about what somebody is doing and try to replicate like their exact strategy. You want to more or less learn from the way that they are managing their positions, right? I think that's one thing that all successful traders have in common.
I always say what I do isn't me making posts about trading. Isn't me going, hey, look how sweet I am. Look at this great trade where I made money. It's me showing you the discipline and the losers. You know, like you get to see the losers, the winners, everything in between. Here you go. Like you look at the portfolio one week, half of the positions are down. You look at the next week, they might be up. You know, like you see the discipline of when I get in and out of trades. And that's really how you trade well. That's the people you learn the most from, is the people who teach you how to manage a portfolio, how to manage risk. It's boring. It's not the fun stuff. If I sat there and made, you know, articles every day about buy copper, it's going to $50, you know, like, or something insane, people would buy it. If I said oil's going to $100 a barrel, people would buy it. I even made my most popular post on my Substack was a post where I said, we're going to all-time highs. I had no idea. The system was just long, you know, like it was just a clickbait post, because at the time I just started the channel and I was trying to make a cool post, and like I was like, oh, didn't it probably going to all-time highs? Everybody was like, great, that's so smart. And I got messages, you nailed it. Well, not really. It was just in a long signal, you know, like it's all it is. Like, so really at the end of the day, it's like all that really matters is like your ability to follow your strategy. Whatever it is, however kooky, weird, funny, follow your strategy. And then on top of it, and what Steven brought up, which is incredibly important, is managing that risk management. How do you put together that risk management profile for your account? Are you going to lose 1% per trade, 2% per trade? Understand the volatility of your portfolio, the volatility of products, back testing. Just so it's not that back testing solves the world. It's just managing expectations. You can't manage your expectations if you're expecting to make all the money on every single trade. It's the reason why, you know, my nephew and I are doing a series, and he was like, he's trying to learn how to trade. He's just asking me questions. And he said, you know, how, you know, what about systems? You know, what's the strategy that you really like? And I go, well, at the end of the day, if I said, here's my exact strategy, which I talk about my strategies all the time. Honestly, anybody can probably figure out my strategy by following me for a couple weeks. But that doesn't matter. It doesn't mean anything. I said, because if you follow my strategy and I just told you, hey, I buy 100-day highs, let's say, and you buy a 100-day high and it loses money once, and you buy a 100-day high again, and it loses money again, and you buy a 100-day high a third time, it loses money. You're going to be like, this guy's an idiot. His system sucks. I don't even understand. But for me, I know the back test. I know that most of the time, I'm running a 1 to 5 risk profile, meaning that I can be wrong a lot and still make money.
Yep.
And so if I'm running that type of risk profile, and then I also understand that, hey, my trades are probably going to be wrong 50% of the time at the least. Probably more than that at times.
What is a 1 to 5 strategy?
I can really stick with it.
Is that like your win rate? What does that mean? 1 to 5.
50% be the win rate. Yeah, like the win rate. If you have a win rate of 50%, 40%, 30% win rate, you can still make money with all those win rates. Most people don't know that, you know, like you still, so the traders that the people subscribe to, they're like, these guys are the best. They're like, I am running especially the systematic ones. They're like, I am running a 90% win rate system. And every time I say that is total bullshit. It's impossible. If you are, it's because you're basically building a system that can be right 9 times and blow up on the 10th time. But here's this one.
Yep.
So this is just a thing I drew up the other week just to kind of show everybody what this means. But this is a 1 in 5 risk profile, 1 to 5. You'd be profitable having only 20% of your trades being right. So once again, you have to understand too, and we all know this, there's a difference between me saying the NASDAQ last year in 23, the NASDAQ will go to all-time highs. That's great. That sounds really cool, but how do you trade that? So trading, it's different. There was times where you needed to get out. There was times where it was trending up perfectly. There was, what was that, September to October, where it was a huge drawdown. So you have to understand how to trade that. So it doesn't even matter. So set up your risk profile right, you'll make money.
Put that table back. Let's explain it a little bit. So
Mhm.
the win rate on my options account fluctuates between about 20 to 30%.
Mhm.
It's my
And
favorite.
options, that's really high.
It's my favorite. During bull markets, this is the best thing I have. Okay.
Mhm.
And what this table is showing is that for that to be profitable, say it's a 20% win rate. Let's assume it's 20% win rate. My winners have to go 5x.
Mhm.
Okay. You're trading long calls, like for example, what was a good one I closed out today? 3M.
Mhm.
Right. So I bought this pullback to this base breakout level in 3M 2 weeks ago. And it was in May 8th.
Mhm.
Yeah, you can see on the chart, right? Got into long calls, went out to June. It's 2 weeks ago. Those calls, this is 3M, this is a Dow stock, it's a blue chip stock, went 7x in a matter of 2 weeks. I lose on 80% of my trades. Okay.
Mhm.
4 out of every 5 more or less go to 0 or down 50%. It's a long call strategy. So when you're wrong, you're very wrong, right?
Mhm.
When I win, I'm incredibly profitable. And they make up for all of those losers and then some, right? So you don't have to come here as a trader and say, I got to be right all the time.
Mhm.
I am rarely right, but this strategy is wildly profitable in bull markets.
Mhm.
And that's fine if you understand that and that psychology works for you. I know a lot of people who would just come up, get rid of the table. I can't, I'm just like a mouth here. A lot of people that just wouldn't like mentally be okay with that, right? Because that 80% loss rate would wear on them, right?
Mhm.
You feel like a loser even though you're winning.
Yeah.
It's so important to understand that table. I think that's great. It's the first time I saw that.
It's the difference between being right and making money. Like it lays it out right in front of you. Here's the difference between it. Because really it's like you could do it a bunch of different ways. In options, you could say, I'm gonna buy $100 option. I'm looking for 5x winners. You know,
Yep.
and if you're doing it in a portfolio like mine, let's say you have $100,000 portfolio as an easy number, and you go, okay, I'm gonna lose $1,000 with the or sorry, yeah, I'm gonna lose $1,000 with hoping to make $5,000 like per trade. Like
Yep.
that means you're losing 1% of your account and hopefully making 5% of your account. Like that's it. That's the secret. That's the secret sauce of trading. The thing that I would always bother everybody about. They would never give me the answer that I wanted. That's the answer. Just find that. It's not about stock picks. Like I thought that too. Everybody does. You know, you think it's stock picks or somebody's going to tell you exactly what to buy, and it's none of that's true. It's just find that table, understand that there's a strategy that makes money flipping a coin. What does that mean? That why people don't make money in finance
I love
and
that.
trading is only because they don't have the discipline. It's not because you're stupid. It's just discipline. So learn that discipline and stick to it, and you'll make money. No matter what your strategy is, really.
And most people can't run a strategy like this because if you have 20 losses in a row, what do? You still take the next trade.
You
Someone, if they have,
you know that you're that much closer to winning, right?
For me, yeah.
maybe,
So
maybe not. Yeah.
but you always go to that, and it's like number one, if you're sitting there, number one, you shouldn't have 20 losers in a row is a lot to happen in a row. Most of the time,
No,
even
in an option strategy, it's if you have a 80% loss rate in an option strategy, I think it's
That happens.
to be
it
expected
can
that
happen. I'm not saying it can't happen.
And you have weeks, you also have weeks where your win rate is 80% and you go in
Mhm.
5x with an 80%
Mhm.
win rate, and that will make up for a quarter.
The whole year, really, you know. But it's more the fact that if you set up your losses properly, that's what everybody doesn't do. It's only setting up your risk properly. If you're buying call options and you have $100,000 account and you're using $1,000 per call option, most people would use 20,000, per call. That's ridiculous. You'll blow up like that. But if you have $100,000, you're using $1,000 per call option. you can do it that way and you won't be killed. You won't look at your account and go, man, it's down 80%. Like you have 20 losses, even you're down 20%. It's not great. That's a really high losing period. But at the same time, you can recover from that. You can't recover though. And this is where I think the miscommunication happens, where people try to do this and then they're having 80% drawdowns. They're doing it the opposite way. They're having an 80% drawdown and then they're trying to come back from that. That'll never happen. So it's really like, it's all about figuring out what type of trader you are. Okay, like I couldn't, option wise, like I can't hang. Like I couldn't do exactly what you do there. And in futures, you don't exactly want to do what I do there. So it's figuring out what type of trader you are. Okay, I'm a futures trader. I'm going to set up my account like this. I'm going to set up my losers like this. And then we're just going to go from there. But do not, no matter what, do not go, okay, I listened to these guys today. Here's my call option. I'm going to do $15,000 for a call option. And I'm going to take the position off when it loses $1,000. Call options and Steve can talk about this a little bit more if you want, but call options, you have to kind of have the ability to understand in your head that these could go to zero.
Yes. My stop is usually zero.
Mm-hmm.
But I think the point you're making is bigger. You have to be really comfortable with the vehicles you're trading. The greatest trader I know, my mentor is Brian Chandler. I was talking to him the other day. So what's been going on? What's new? I was experimenting with a futures account, right? Trading S&P futures. Got destroyed. I'm like, but Brian, you trade SPY all the time. No, I just, I don't know what it was. That's not his vehicle, right? Futures aren't for him. They're not for me either, like you said. Options, I started my career auditing broker-dealers. I was the derivatives valuation guy. I was on the options desk. I got to know these things really well, understand how they work, understanding all the Greeks. I'm comfortable, right? These are my vehicles, right? I feel good trading these. I know how they move. I know the character of them. I watch the prices of different options contracts throughout the day, right? Just like I watch the prices of different stocks. That's where I'm comfortable, right?
And I know one or two people in my whole life that trade explorers and juniors well, and that's Kashab. Like it's just understanding where you fit in, and how to handle that, and then the risk around it. What's the risk around it? Do I think of options as they can go to zero? Do I think of explorers as they can go to zero? What exactly is the way to look at that? And for me, I'm very comfortable with futures because I know where my stop is. I can set up my risk very easily. Options also kind of have that built-in risk profile too, where you can go, okay, as long as you think in your head it's going to go to zero. I have watched so many people lose so much money, including people you would be like, this guy's a fund manager. He's a genius. I've watched so many people go, I'm going to buy these options and I'm going to like run a stop loss, or I'm going to, do this in my, and it just, it doesn't work. And stop losses do not work in options. That is a ridiculous thing to do.
Your stop loss should be based on the common, right? And then you take what you can get at that price on your options.
Yeah, and it could be nothing.
Yeah, it's just going to be nothing a lot of times.
So so the people I've seen, and to this day, even when like we have like 1 or 2 options trades a year in the fund. We had oil this year. Yeah.
You go YOLO. You do a little YOLOs here and there?
No, it's literally like 1 or 2 like a year. And Kashab knows this. It's literally 1 or 2 a year. Sometimes it'll be like, and it has to be this perfect profile for me to do it. Oil was that earlier this year. Perfect profile. The premium was so cheap. Volatility was so low, considering everything that was going on. Not to mention, it was very close to a breakout zone. So basically, we bought some calls. That's it. But however, I always size it for the fund. It's 1% of the overall fund. That's it. Just 1%. If I lose it, I lose it. And it, once again, just like you had recently on some of your trades, like it can be a 5x, it can be a 10x. You have no idea where it can go.
It could be material to your fund's performance.
It could be zero. But zero is just 1% loss. So that, I think that's the end of the day, is that what really is important and something to stick in everybody's head going forward is if you think of every trade as it's just a 1% loss or a 2% loss, whatever it is in your whole portfolio, then you can make money. Then you have a strategy and a way of building your portfolio. Wow, I can't say that word, I guess. That can consistently make money over time. So before we go, we had a couple good questions I wanted to go through. When in your development as a trader, when in your development as a trader, did you stop linking your feelings to your P&L?
I don't know if it's so much feelings, but it's your perception of yourself, right? You're going to feel your P&L for the most part. And that's healthy, I think, too, right? If you at least feel it in the right way. But you don't want to, for example, I can have a bad week where I'm losing on all of these options traded. Really doesn't phase me. I feel it. I know it happened, but I'm not like, oh, fuck, I got to hang this thing up. It's not working. No, it's like, yeah, it sucks. It was one of those weeks, right? You feel it, but it's how you kind of digest those thoughts and react to them, right? You got to be really okay with it.
Go ahead, Kashaf.
I haven't gotten to the point where I stop linking my feelings to my P&L. So, but what I do is when I have a big win streak, I just ignore the number until the weekend or until the end of the month, so that that number isn't in my mind while I'm trading, because then it really messes everything up. In a losing streak, of course, you're going to feel it. In fact, I'm going to probably be looking at the loss on a minute to minute basis and thinking about it. And when I'm sleeping, I'm thinking about it. And that's also what tells me that it's enough, and whatever is bothering me, I need to cut it. And then things pick up. So I just haven't gotten to the point where I can be like Tom Basso or Mr. Serenity, where I can just take trading as one aspect of my life and have the other aspects of my life. I'm not at that point.
So, I mean, so it's interesting, and I just posted it in the chat for you guys on YouTube. The last interview I did with Mr. Breakouts. I know he has a funny name, but damn, I absolutely love this interview. One of the coolest interviews I've gotten to do in a while, and we didn't talk really about trading or strategies nearly enough. We talked really about this one thing, and he talked about compensating, the idea of compensating and keeping up with the Joneses and this stuff. And the thing that I think sometimes really gets in most traders' way is the idea that, hey, my P&L is like this, and I'm not doing as good as this guy. And because I'm not doing as good as this guy, I'm a bad trader. I think you'll always get to a point where you're like, man, like I need to do better. I want to, because you're a trader. Traders' mentalities are just like that. But there's a difference between being wrapped up in it and not. I think something that helps is understanding, for me, the market environment. If the market is conducive to my strategy, I should be doing well. In 2022, I even struggled with it because I had funds getting like, and I didn't really understand what their problem was. And it wasn't exactly that they were having an issue or they were having an issue with me. They were having an issue with themselves. And so I put together a really great year in 22 for me. We had a really good Q1. It basically held up the whole year. And then, but we didn't have any, I didn't have any gains or hit new equity highs for those 3 quarters, basically. And so, you know, even though we were up for the year in a year where the market was down 20%, we were up over 20%. And so when I look back at that, I realized how like upset I was at the time, but also it was because I was letting other people kind of drive that. Like I'm letting these people go, well, you know, you're the only trader for us that's doing well. You need to keep doing well. And it's like, well, the market is not conducive to anybody's strategy right now. Everybody's losing money. My goal here is to protect money. So at the end of the day, I kind of go with this rule for myself is I'm doing well as a trader as long as I'm protecting the money. I don't care the gains, like Kashaf said, like I don't look at the gains when I'm having great weeks. I try my best not to talk about it, feel anything about it, post about it, anything. because it just doesn't matter. At the end of the day, my head might get into that, and then I might get too excited about it. And then also, if you're not getting too high on the highs, you're also not going to get too low on the lows, going, oh man, now I'm down. Like, can't believe I'm down. I just look at it quarterly, look at it yearly. How are you doing year over year? Some of our best years we've had nasty drawdowns. Some of our worst years, we've had like great months and very smooth returns. So once again, it's like, and we haven't had, I'm fortunate, I should knock on something, but we've had great years since we started the fund. But at the same time, it's a process. That's important to say over everything else. It's a process to understand that your trading means nothing to your life. You are an entire human being. You can do great things. And sometimes the market isn't conducive to your strategy. And the secret really to trading well is understanding that if the market isn't conducive to my strategy, I need to protect my money so I can be around when it is conducive to my strategy. All right, well, we'll end there unless anybody else has anything to add. I know we went a little bit over time. Thanks for hanging out with us, everybody.
This was fun. Happy Friday, guys.
Happy Friday, Steve. I'll see you soon in Sonoma next week.
See you Sunday, Monday. When you get in?
I'm getting Monday, but it's late, I think. So I'll probably see you Tuesday.
All right, we'll talk. I'm looking forward to it.
All right, man. Me too. Later, Kashop.
Yeah. Bye, Steve. Bye, Jason.
Oh, wait, Kashop. Steve, if you need to go, you can go. I forgot. Kashop had something here. That was a question.
All right. Later, gentlemen.
All right. Later. I think it was this one. Do you have some investments or trades on assets with not so much data as well? And I think what he's trying to say is, go ahead. You know better than me.
Yeah. So in terms of the small cap stocks, absolutely. So it's just that I have a background in mining and exploration. So I spent almost 5 years going over every drill result put out by every junior mining stock. So I built a database of that. So I got to know that space really well. And over the years, so the thing is, it's the same management teams that keep circulating over and over. It's new companies, but the same people. And this is the same properties with new names or adjacent properties. And when you kind of develop a mental database of it, you can take those judgment calls without having as much data. So if, let's say, I'm looking at a particular drill result of copper intercept in a part of Chile that I know has a lot of copper and a lot of copper mines, I would pay more attention to it. I would trust it even if I didn't really understand the company or much about it. And if the price looks cheap enough, I would take a trade on it. But the way to go about it is to know that when you're taking those kind of calls, 90% of the time, 80% of the time, if you're wrong, you should be able to deal with it and deal with the fact that your investment goes for a toss. And at the same time, on the other end of it, when you have a lot of hype around a drill result and you have a lot of people paying attention to it and you have massive 10-20x volumes come in, it doesn't matter what you think, that's when you need to take your exit. Because if you don't take your exit, then chances are you're not going to have that one winner that pays for those inevitable loser. You're just going to ride your winner up and then down, and then you're going to end up with nothing to show for it. And that's the reason all these small cap stocks get a bad name, because it's not that these are bad companies, it's not that they have fraudulent management teams or bad accounting or anything like that. It's just that when you get your liquidity exit, if you don't take it, if you don't de-risk, then you're not going to be able to ride the cycle. And so in a market, the cycle is the macroeconomic cycle. That's the Fed cycle. In small cap companies, in all these pre-revenue companies where there's no money coming in, but they're burning cash, the cycle is the financing cycle. So if you don't understand the financing cycle, you will get burnt. And It's just that I have built this expertise over so many years of doing this that I kind of understand it. But I would not recommend anyone to do this unless they are prepared to go through that learning curve. And I think it's the same with any strategy. Even if you're trading futures, if you're trading options, there is going to be a learning curve where you get burnt and you learn. And I was just fortunate that I got paid for my learning curve. So I worked as an analyst and I got paid for doing this. So now I have the skill that I can put to work. But yeah, I would really not recommend doing this unless you can go through that pain, go through those years where you learn that. Jason, do you
No,
have
that's a
anything
great
to add
point.
there?
Great point. No, I love that. All right, guys, I gotta run. All right, Kashap, thanks so much for coming on, man. We'll see you next week.
Yeah, see you, Jason. This has been great.
Yep. Hey, speaking of which, do you want to come on Monday? Kevin's going to be out of town. Do you want to do the commodity report with me?
Yeah, sure. Let's do that.
All right. I'll send you a link.
Sure.
All right. See you guys on Monday at, we'll probably do it the same time, 11 a.m. on Monday for the commodity report. See you guys later.